just to be safe. All right, we are live. Good to go. Okay, so let me get this disclosure out of the way real quick, as I always do at the beginning of the videos. Content in this material is for general information only and not intended to provide advice or recommendations for any individual. This information is also not intended to be a substitute for individualized legal advice. Please consult your legal advisor regarding your specific situation. Guest speakers, LPL Financial are separate entities. Securities and advisory services offered through LPL Financial are registered investment advisor, member FINRA, SIPC. Okay, I always like to get that out of the way first, just to be sure. So I am here with Mitch Goldberg, and I am excited to be able to take advantage of his experience and ask him a few questions. He is another advisor out in New York, and I want to give you a few seconds to introduce yourself. So why don't you say hi and give us a little background before we get going with the big topic, which you can see below is the economic update. Where are we heading?
Hey, Ryan, thank you so much for having me as a guest on your show. Just want to start by saying I really appreciate what you're doing for our financial advisor community by featuring other financial advisors and getting input. Even if we agree on it already, it's just great that you're doing this. And I think it's a big help. And I think it's very, well, it adds a lot of fun to it. It adds a lot of knowledge and experience. So if we haven't met yet, I am Mitch Goldberg. I too am a financial advisor with Client First Strategy. A few things about myself. I've been in the industry now. I just recently had my 30-year anniversary in the securities industry. I love creating content. I work with retail clients. That means everyday people, not institutional type clients. And I have a live show called Be the Boss of Your Money that I live stream every day at 4:30. And I'm also a contributor to CNBC.com and a couple of other things. That's me in a nutshell.
That's
just a regular guy.
Yeah, that's awesome. One of the reasons also where I started really paying attention was your LinkedIn lives and you sharing daily market updates, because as somebody who started posting every day on LinkedIn, I realized how much work that takes. And I'm sure even with your experience, it's easier for you to talk about the subjects, but when we're talking about specific situations, you still got to look things up. You know, when you're relaying the screen, you got to make sure that it's all going to work, that you got the right tabs open. So I know there's a lot of work that goes into it. So I always appreciate learning from there. There's a ton of value in that. And I definitely encourage people, if they're on LinkedIn, to get on LinkedIn, but if they're not, or if they are, to really pay attention to those and watch your videos. They've really helped me, especially as being an advisor, learning, and just as somebody putting in the time, showing us daily and giving us your point of view over your 30-year experience has really been helpful.
Well, thank you very much. But we all have a lot to learn. The learning never stops. And there's new things. Look what we're going through right now, this pandemic, recession. So what if you've been in the business for 30 years or 3 years? This is new for everybody, and nobody had any experience from which to draw on to get through this. So we're all neophytes today. We're all just starting out in a way.
Yeah,
we're doing it together. The industry that we're in, it's truly the best it's ever been. And we're all in it together, and the amount of sharing that you do and some of our other, LinkedIn buddies, it's really it's remarkable. And I appreciate the opportunity to continue with you. And I've learned from your post too. I noticed you were doing something called and you're still doing it, the LinkedIn challenge or something. You're creating content daily.
Yes. Yeah. So I started doing that just as a way to brand it, push myself, hold myself accountable and things like that. But whether it's a post, and really I realized that posting every day was fine, but I just wanted to do something different, have fun with it. So I've just been trying to post any type of content, whether it be videos. Sometimes I'll do a text on a picture, like a quote card or something. And just anything I can do to just put myself out there each day, for a full year, for 365 days, and just see how it goes. I'm learning a ton by doing it, and it's been fun.
You learn a lot by doing it.
For sure. Just by doing, yeah. I mean, you can read all the books and, working with great people, if you can outsource it, that's one thing. That's great. But if you can't afford it, you got to do it to really learn it, to get good at it. I don't see another way. So
no, I've seen people try to outsource this sort of thing. And we were talking about this before, how it's blatantly obvious when somebody outsources it. It's so bland and so generic and so obvious what people are saying, that there's no depth, there's no perspective in it.
Yeah. Yeah. I try to differentiate by being a real person. I mean, that's what drew me to you was your own flavor on things and personality. I could tell the difference, like you said, about a lot of the other advisors. And I don't want, LinkedIn to just be a place where we're all, I guess, like high-fiving each other and stuff. But just like you said, we're really learning. Like, it really does help. It's been a real place that I've learned a lot. I mean, even specific planning techniques, not just life stuff or, experience stuff, specific planning techniques that I can take the clients and save them money. So it's, it's a great, I don't know, it's been a good place to spend time for me. So
it is. And you learn, I learn a lot. Even when I think I know about a topic or a subject, knowing that I am going to go live or create a written piece or an edited video, when I create content, you think you know about a subject until you actually have to talk about it. And then you realize how much fact checking and background and research that you have to gather in order to make sure it comes out right.
I love that you said that, because me being 5 years in, I felt like that's a 5 years in thing. But what I realized is what you said is it's really just you're about to speak. Like, you want to make sure, obviously, you don't sound dumb, and you want to make sure everything's right. You want to bring value. And that's exactly how I felt, where I'm like, I'm pretty sure I know what these are, but let me look this up. Let me go right to the website. Let me get the numbers down before I get going. And 100%, I know exactly how you feel and what you're saying.
Yep. So we're talking about the economy, the economic update, because everybody's asking, like, the two big questions are, where is the economy going? Where are we heading? Yep. And how could the stock market possibly be doing so well? The NASDAQ 100, which is an index, and you cannot invest directly into an index, but you could invest in a security that tracks or mimics an index. Just had to, we want to make sure we get the disclosures in there, right?
Absolutely, yeah.
I'm doing this a long time.
No, I understand. I appreciate it.
I speak in compliance language.
It's like an elevator speech at this point.
Exactly. But everybody asking, how could, the NASDAQ 100 actually hit a new high today? I mean, think about that. So how could stocks be doing well when the economy is doing so badly? And you have to separate the two, because if the stock market truly reflected the current state of the economy, the stock market would be considerably lower. How much lower? 40, 50%? It's tough to say, but let's just say considerably lower. But it's not. So we have to think in terms of what happened for the economy. The stock market plunged 34%, record time from record to recession. Record. And stock market went down, as measured by the S&P 500, down 34%. It went down ahead of most of the really, really bad economic news, well ahead of that. So the stock market did have its plunge, and then it's coming out of it in record time. We just had like a record peak to trough. I think from the March 23rd low to where we are now, the NASDAQ Composite, Dow Jones Industrial Average, and S&P are all up about 45% since just that time frame. That is a massive move. You really feel bad for those people who decided, I'm going to sell everything and go to cash, and I'll be able to get back in when things are lower.
Absolutely. Yeah. And especially that, because I think, just like you said, is the stock market and the economy are two separate things. And if you think about exactly where it's going and you're not understanding a long-term plan, that's when people, I think, start to panic sell, at least, talking to clients specifically who are like, hey, are we okay? And not necessarily people that want to do everything. They're just like, should we make any moves? And I'm just like, absolutely not. The market halted 4 times. I'm like, absolutely not. It's jumping around too fast to catch. And I just think, it's kind of like, think of our long-term plan of why we did this. And just like we said, not to say it won't go lower, but now we are where we are. And, we're able to at least have those conversations now where it's like, okay, look what happened. So even if it does go back down, we've seen a recovery. So right. We're sticking to this long-term plan.
And I say to clients, let's remember that bad feeling of how everything was falling apart in the world, and we got through it. Remember, everything is a cycle. This is why we say market timing is so tough to do. Mm-hmm. But more importantly, the economy and the stock market are not necessarily joined at the hip. What's driving things now is the expectation that the economy will move on. The pandemic is being treated like an event, almost like a natural disaster, like a big hurricane rips through a portion of the country. It's tough for a couple of days. We come out of it. I mean, this is obviously much tougher. You can't compare it. And there were lives that were lost. I'm not trying. I'm choosing my words carefully. I don't want to come off insensitive. But,
no. I understand.
We're talking about the economy,
right?
But the pandemic is being treated like an event, and the event is ending, and the states are reopening. It's going along pretty well. It's happening a lot quicker than people expected. That's what's moving this. So when the stock market was all the way down 34%, we were still trying to factor in with price discovery a worst case scenario. We didn't get the worst case scenario. So that helped the market rebound initially off its March 23rd low, and then the states reopening. And, we might not go back to as good of an economy as we had previously, but the stocks that are benefiting from the situation are the biggest stocks like Amazon, Facebook, Microsoft, okay? Since they're the biggest companies, they have the biggest representation in the S&P 500 index. Well, it just happens to be it's a perfectly good storm for them. They're benefiting, they're going up, and it's pulling the whole stock market with them because they're so big.
Interesting, right? that when we thought that I guess as a recession, it drags the whole stock market down. But in this specific situation, it's really punching a few industries a lot harder than others. And they're not the ones that you're saying are like pulling the weight, like the biggest forces that are pulling the carriage in the front.
Look, if Norwegian Cruise Lines or Macy's, let's see, Macy's, what are some of the other disasters? Okay, American Airlines. If their stocks disappeared this afternoon, you wouldn't even notice it if you were just looking at the S&P 500 index because they're so small. And then you have trillion-dollar companies like Microsoft, Amazon, that if they go down a lot, yeah, you'll feel it. But it's the mechanics of how the S&P 500 index works that's really moving the market higher, not the economy.
Yep.
Does that make sense?
Yeah, it does. And something I'm reading into, and I don't want to get too technical, but in terms of companies, depending on how much money they make, obviously get moved around. So I guess in that sense, as some get lower to small cap and mid cap, you start moving different categories.
Yeah. Look, which companies are benefiting from the whole work from home, constantly looking at your screens, and remote working? They're the biggest companies. So it's like not only the big, if Microsoft and Amazon and Facebook, and Alphabet, if they were the smallest companies in the S&P 500, then we would be a lot lower. It just happens to be that they're big companies, and this truly is like their time to shine. And they're shining. They have capitalized on the current environment, not because they did something nefarious or they did something 5 minutes before the pandemic broke out. It's just that the way they've been built, they are the choice of stocks for any investor who wants to put money to work and who's looking for, what I would say, dependable growth.
Right. So with that, I want to rattle off a couple questions to you that I wrote down. I wrote a couple questions that I had for just a couple real world, reasonable questions. I just wanted to rattle off to you, see what you have to say, and go a little bit back and forth with it, but really give you a chance just to see what you think. So with that, let's start with first this is the end one I want to end with. So where are we heading? You kind of led with that, and I want to ask a few questions and then kind of get your opinion, ending on I guess where you think you're going or what it takes to get there. So let me rattle off the first question to you. We kind of got into this before. Why do stocks continue to improve as corporate earnings remain lower than normal and almost 40 million people unemployed?
Wow, it's such a easy question to ask, right? It's such a tough one to answer, but I can answer it pretty quickly, pretty succinctly.
Yeah.
Okay. First of all, the stocks that did get crushed because the stock market's doing exactly what it's supposed to be doing, first of all. And that is giving investors an opportunity to help pick winners and losers in an economy. It's capitalism at its best. And if you look at just like the airline sector, the cruise line sector, the retail sector, excluding, Costco and Walmart and maybe Target, stocks were showing a depression era level, but they've gotten so low. I'm not making a call if they're cheap or good values, but I could say they've gotten so low and expectations were so low for these companies that all of a sudden, just the fact that they might actually survive, even if just a shell of their former selves, that is better than expected. That's an improvement, which means these stocks are probably sold off too hard. And now that it looks like the economy is going to recover, even if it doesn't get to what it was, get back to at least, a positive or even GDP, then these companies' earnings and revenues should rebound, and the stock should be valued much higher. So that's what's driving the stocks. That's what's driving earnings expectations, and that's what's driving the economy.
So I guess it does go back to, there is obviously some technical accounting, share price things going on, earnings that do attach to it. But it seems like, when you're dealing with the stock market, there's obviously a lot of human beings involved. There's obviously a lot of fear involved. So people are making moves and making, I guess, emotional decisions. And that could affect where it goes even faster, which is why the economy doesn't weigh so hard on it, because it's I guess led by people and their emotions more than the data at hand.
Well, it's the aggregate of all of our actions put together, which I think makes studying the stock market so fascinating when you look at the study of economics. But investors are looking past this valley; they're already looking toward the next peak. So, stocks are supposed to be a forward-looking indicator. And, what I said in March 24th on my live show, I said we hit the bottom yesterday. And the reason I said that is because if the government is going to throw out $7 or $8 trillion of stimulus, and if the government and the Federal Reserve are basically going to take over the economy and get us through this, and we start reopening the states, then that whole giant sell-off was really for nothing. And this is, to your point, to acting on emotions. It's, look, when people are scared, they're going to act to protect themselves, and it's that flight or fight instinct, that mechanism. We know investing based on emotion is a horrible combination, but we are still humans. But right now they're the S&P 500 about a week ago crossed over its 200 moving day average for the first time. We're talking about technicals. And once it went over its 200 moving day average, that's kind of a signal to fund managers and hedge funds and large investors who have gotten too heavy into cash. They look at that indicator over the 200 moving day average and they say, wow, that's at a point where we raised too much cash. We got too conservative or too risk down. And now we're lacking. Our performance is way behind the market. And now we've got to do a catch-up trade. So we've got to start buying everything that could possibly move, especially those high beta stocks that could really rebound a lot. And that's like those beaten down, crushed names like airlines, like cruise lines, and some of the retailers. And I mean, even today, I think American is up something like 20%. Boeing yesterday had a huge day and it's up again today. Those are the stocks that money managers are running into that could really have a big pop from cyclicality. So that's what's driving the market right now. It's not really food stocks, pantry stocks that are leading the market. They led the market, 3 or 4 weeks ago. They were leading the market, but
right.
that baton has been handed off already.
Right. Yeah. It's crazy to see that. It's almost like a reoccurring game where it seems that people are chasing the stocks that they want to go up, and they almost cause it by throwing, I guess, so much money back into it. Like, just like the massive sell-off, a massive buy, I guess things start to pop back up. It just seems like a returning game of somebody chasing their tail.
It's just, sector rotation. I've never seen sector rotation like this, and this is why it's people advise you have a diversified portfolio. Wait a second, Ryan. I just have to say, diversification is a strategy that we use to reduce risk, but it does not necessarily protect your overall portfolio from going down in a generally down market. So was that good? That was good, right? Okay,
that was good. Perfect. Yeah, I'm glad I have you here. I gotta get on that myself. I'm gonna get an email if I don't. If I don't,
what it's like. It's almost like when you hear when you watch like the drug commercials on TV.
Yeah.
They talk about like that the happy, person who took this drug and now they don't have to pee every 5 minutes and they could run around and live this great life. And then you hear in the background for like 15 seconds, you'll probably die. Your head will fall off. Your hair will fall. All of these little things. That's what I feel like these disclaimers are, and that's why I put my face. One of his on
exactly.
For details.
Absolutely.
Okay. So,
yes.
Yeah. Where were we? Stocks.
Something about the economy. Something about the economy.
All right. So if I could ask a question that I've been getting asked a lot. So to follow on with what you asked, and I think this is a good segue. So then people ask, yeah, but even if the economy does recover, we're still not going to have all these restaurants and stores open. There's still going to be a lot of people left behind. There's still going to be a lot of consumers that just won't make it back. A lot of businesses, small businesses, just won't make it back. So won't that eventually catch up to the stock market because there'll be fewer people spending money, more people collecting social benefits?
Yes.
And it's a really good question. And the answer is it's tough to say. I don't really know, because you still have the stimulus, you still have people collecting social benefits, but you have an awful lot of people who are working. And if you just saw like the mortgage applications have been jumping because of not just refinances, which is actually getting a little harder to do, but the first time home buyers, in other words, the millennial generation, are out in force right now buying homes. So what about that? Okay, so for every counter, I could counter it.
Right.
And that's
right.
why it's so tough to say, well, where do we go from here? Because we did have the rally in the stock market. So does the economy have to catch up to that? Is the stock market ahead of the economy? I would say, yeah, the economy is, the stock market's ahead of the economy right now. And that's the way it's supposed to be. But we'll see how the employment figures come out over the next couple of months to see if we can get some positive GDP numbers by the end of this year or first quarter 2021. So
I think the other interesting thing that I'd like to ask you about is with mortgages were a big issue like in 2008. And I think one of the fears was with people missing a couple payments, there's big deals, obviously not just businesses, but people who are renters, landlords, people not being able to pay the banks and things like that. It does seem, though, that stimulus is working to not allow what we're fearing, worst case scenario. It seems like every time we picture worst case scenario, they put their foot in the door before it closes. But what do you think about the effect of that? Yeah. What do you think about eventually the banks got to get paid. So yeah, where do you think that leads us?
There's a moratorium on evictions and foreclosures. And there are some people who are calling for a eviction and foreclosure cliff, that when the moratoriums go away, that's when landlords and banks are going to say to residents, they're going to say, whether if you're in a single family home or an apartment, whatnot, that, hey, you got to pay us now. And you owe like 3 months worth of rent. And listen, if you had trouble paying your rent or your mortgage, I don't know where you're going to come up with 3 months worth all of a sudden. So that's another thing to worry about, and it'll have to be worked out. I think the worst thing probably for landlords and banks is for massive foreclosures and people getting kicked out of their homes. Right. So that's probably the worst thing. So I don't think we get a worst case scenario. I just think we plod along and banks and landlords will work it out in terms of getting paid back. It hasn't affected the financial markets because ultimately you and I and our clients own these mortgages in investor portfolios, your bond funds, eventually this stuff finds its way to the securitized market, securities, right? And it's packaged and we own it. Either pension plans own it or, hedge funds, endowments, so one way or another, the public does own this stuff. So I haven't seen this anywhere become a financial contagion issue yet. And it's tough to say it'll go there because even if banks have to and landlords have to issue new bonds and new debt, the Federal Reserve said they'll buy all the debt. So you don't even have to worry about securitizing debt. So I don't think it's going to be a disaster. It's certainly helped, though, to your point. It has sure helped a lot when you don't see people, massive evictions. But it takes time for that stuff to happen. And nobody wants to go through what we went through in 2008, 2009. Nobody wants to go through that again.
Right, so. For sure. So we kind of touched on this, I feel, every time by leading into it, by talking about the economy, wondering where we're going. But I think there's a lot of things that are up in the air, and there's always ever-changing variables. So that's why it makes it so difficult to predict where we're going to go, because just like we said, all the questions that even have answers always end up with, like, let's see what happens, because it needs to play out. We need more data to see what's going to happen. But I guess with the passing note, where do you think we're heading from here? Or what do you think the next steps are going to be, I guess, to continue to pull the stock market up? Or what do you think is going to push it up all by itself?
Well, I short term, it's up to the employment figures. Okay, like tomorrow we get the non-farm payroll number, right? Tomorrow, June 5th. And we need to see some kind of evidence that businesses are rehiring people. If we get too good of a number, I actually think the market would trade down on that. Kind of buy the rumor, sell the news. Because if it's too good of a number, that might hurt the chances for more stimulus or the HEROES Act or whatever's going through Congress right now.
Right.
But we need to see a somewhat quicker than gradual improvement in the employment picture. And eventually, if we don't see it, then you have to start to think, well, I guess the states reopening are not going as quickly as we thought or as well as we thought. So therefore, the stock market has gotten ahead of itself, and we're going to see a pullback. That's the way I see it, plodding along back and forth between expectations going up and down in terms of the economic recovery.
And that's interesting what you said about the news, because I agree with you in terms of when I was watching the stock market, I think one of the first times it halted was because we heard news about stimulus, which is the Fed saying, hey, we're going to come help. And then everybody went, uh-oh. And now I realize how bad it is. Like, they're starting to step in. So I think that what they saw was the future of what's happening. Then people started freaking out. So
they didn't step in. Yeah, they didn't step in because things are good. The Fed in 2 weeks gave through more stimulus at the economy in 2 weeks than the entire length of the Great Recession. I mean, Jerome Powell, Fed chairman, he looked into the abyss and he saw something that really scared him. Yeah. And that's what people were thinking, wow, things are way worse than we thought. And that's really what kept the market going down and down and down. But we worked our way through it.
And it makes me wonder if sometimes they're looking at this and they go, look, last time we waited a long time and we threw a lot of money at it and it dragged us down for a couple months. They were like, we've seen this before. Let's just hit it now and throw it in and see if we can get it to rebound quicker than without dragging us out. It makes you think, especially with them digging into buying stocks. And I know this could be a whole nother segment. Are they going to be capable of stopping what it feels like? I mean, there's still going to be economic recessions, but do you think they're going to stop the recession feeling from the stock market?
Wow. What is it? Behavioral psychology is a lot different than throwing stimulus at the economy, right? So the I don't know when people's psychology is going to change. There are a lot of people who are walking around with damaged hearts and minds right now from this. A lot of people have had the rug pulled out from under them. You and I are fortunate that we're in an industry that we could work from home. The stock market never closed. We had a reason to keep going to work every day. We're getting paid for it. We're very fortunate, but a lot of people didn't have that. That's a big part of the population. When do we get back to that? I think it'll happen pretty soon. I think it's already starting to happen just by, you see all these masses of people going back to stores, going back to beaches, socializing again. And then we'll have to worry about the coronavirus. And if we have a rebound in the fall, for that. Look, there's still an awful lot of things to worry about and a lot of big question marks hanging over our heads. They're not going to go away. And if we don't have those question marks, we'll have different ones. So
right.
This is why we diversify. We invest for the long term. And you tell your clients the same thing I tell my clients. Really, it's dependent on your own personal time horizon, risk tolerance, and financial goals. And no matter what your opinion is or my opinion is of the stock market over the short and intermediate term, we're still going to manage people's the advice we give them the same way. Right.
Absolutely. And, maybe with this having so many ever-changing variables, maybe we can do this again in maybe, a month or two and kind of give another update, see where things have turned, kind of see whether it goes back down, holds steady, goes high, and just do another fun update. I really appreciate you being here and kind of giving us your experience and giving us your answers. I appreciate you taking, some of everything you've learned over your years.
It's an honor for someone to ask me, when your peers ask you to participate, it's an honor. And you said to me, Mitch, these live streams go very quickly. We've been on for like 32 minutes, and I feel like we've been on for like 1 minute. It's amazing. Thank you so much for having me.
Absolutely. Absolutely. So I hope to do this again. Again, thank you so much. And I hope you have a great rest of your day.
My pleasure.